It's now time to dive into some of the detail of how to set net zero emissions targets in the finance sector. Over the next hour or so, we're going to get a bit workshoppy and get into some of the nitty-gritty and the detail of what companies can do, what investors can do to really drive forward the net zero finance revolution. To help navigate these choppy waters, we welcome Nate Aden, who is Senior Associate and Finance Lead at the Science Based Target Initiative, or SBTi, as many of you will know it, and Stephanie Chang, who is Head of ESG Integration at our partner Schroders. Welcome both. Thanks so much for joining us here. And as I said, we're getting a bit workshoppy this afternoon. So as I understand it, you have some slides to kick us off and provide us with a bit of a starting ground for our conversation on setting science-based targets for financial institutions. As ever, if people have questions or queries, please drop them in the chat and I will try and put them to our experts. But first up, I'm going to go to Nate to deliver his short presentation.
Great. Thank you very much, James. And thank you to Incisive Media and BusinessGreen for inviting me back. And congratulations on a second year in a row here of net zero discussion and the Finance Festival this year. So I, as James mentioned, am the Science-Based Targets Initiative lead for financial sector work. And I'll just be providing a very short overview of our work on financial sector targets and the net zero standard that we're developing this year. So in the next slide, you could just see just sort of some background here. Since I presented at this conference last year, we've doubled at the SBT initiative and we're experiencing exponential growth at this point. Now we have approaching 3,000 companies and financial institutions that have committed to setting SBTs, of which about 1,300 have approved SBTs. And you can see the financial institution work is ramping up very quickly within that group with 140 committed financial institutions and 20, of course, including Schroders here, which we're very happy to have on this panel as well. The next slide just gives an overview of the financial sector framework that we released back in October of 2020. And this is the resource that financial institutions are using to set near-term science-based targets now. It includes a set of 3 methods for setting investment and lending portfolio targets, as well as a set of criteria specific to financial institutions for these near-term target formulations, a new temperature rating tool that is the first publicly available, transparent online tool that we published on GitHub back in 2020, as well as a guidance document that describes these methods and resources, as well as presenting 8 financial institution case studies of financial institutions applying these methods and tool and resources. The next slide just gives a little bit more information about the 3 methods that we included in the framework. So the first is a physical intensity method that links particular asset class targets with 1.5 degree or well below 2 degree stabilization pathways. And so, for example, for electricity generation project finance, this would give a pathway in terms of grams CO2 equivalent per kilowatt hour of electricity generated that the financial institutions then can use to engage with their clients and investees to help them set targets. Then these other 2 methods are more engagement oriented. So the second one is SBT portfolio coverage, which is the idea that the financial institution engages with their investees to have them set science-based targets. And then finally, the third method is what we call the temperature rating approach, which is one whereby the financial institutions engage with their clients to have them set quantitative emission reduction targets that are then aggregated up to the total portfolio level. And this is an engagement approach that is increasingly popular and in fact was used by Schroders in their target formulation. So we're very happy again to have Schroders here. The next slide steps back a little bit to talk about our net zero standard. So the SBT initiative has historically been focused on near-term targets, but with the publication of the IPCC Special Report on 1.5 in 2018, the initiative began to pivot towards net zero as that formulation became more and more prevalent for climate ambition. Obviously, this is a net zero gathering here today. And so I'll just describe briefly the SBT initiative work in this space. last October, we published our corporate net zero standard that we're now using to assess company net zero targets. And that was the result of more than a year of standard development work with an expert advisory group and extensive stakeholder engagement. Now we're engaging with that process for financial institutions. So at COP26 last November, we published an initial net zero for financial institutions foundations draft for public consultation. Many of you and your colleagues provided feedback on that draft, which we appreciate. We had more than 130 responses to our survey. And now next month, we'll be releasing the revised foundations paper, which will commence our net zero for financial institutions standard development process that will go for about a year. It'll include its own expert advisory group. And this standard will then be used by the Science Based Targets Initiative to provide independent assessment of financial institutions' net zero targets. The next slide just reminds everyone that as we are in that process, of course, all of you are invited to participate in the net zero standard development process for financial institutions. But in the meantime, we invite you to follow Schroders' excellent example and take near-term action on your actual investment and lending portfolios with near-term targets that can be submitted and assessed by the SBT initiative today. I think the next slide just closes this out, and I will be happy to discuss further, but in the meantime, I'll pass it to Stephanie. Thanks.
Thanks very much, Nate. Thank you for the kind words as well. So I am going to take the next 5 minutes just to talk a little bit about why Schroders decided to commit to SBTi, why we picked SBTi out of the many frameworks out there, but also how we went about it and some of the challenges we faced along the way. So if I start with sort of the really obvious, Schroders is quite committed to climate leadership. On the next slide, please. And I don't need to tell anyone dialing into this call, for example, the huge implications that climate change is going to bring to us as a global economy and to us as humanity. And what this means for us as active asset managers really is that we are responsible for protecting our clients' money from the risks that climate change presents, but also to ensure that we capture the opportunities that the transition will represent. And so for us, establishing our science-based targets is naturally just an expression of that commitment. We wanted a robust evidence-based way to do that, and we felt that SBTi was the way forward. Clearly also by committing to SBTi, for all the reasons that Nate's gone through, for example, he's mentioned the framework. We think SBTi is the leading industry standard. The guidance is practical, it's pragmatic. There are a bunch of resources, there's open source methodology. For us, this just represented a nice, neat, complete package. And the bonus, of course, is that SBTi then comes in and validates our targets. And for us, that sort of robustness of having an external party vet your targets adds to the ability to enable comparison and accountability across the rest of the asset management industry. So we at Schroders are very proud to be the largest asset manager by AUM to date. Still, I think that's true, Nate, to have our science-based targets validated by the SBTi. If we move on to the next slide, then I'll come to how we went about doing it. I've set it out on one slide, but actually this process took a lot longer and was a lot harder than this one slide makes it seem. So all in all, I would say from start to end, the process was about 8 months. So this is not including the time between from the time which we submitted to SBTi and the time SBTi came back to us. So this is just the in-house Schroders time frame. We started with basically just defining the scope. The SBTi guidance is quite clear. It's table 5.2. It's sort of imprinted in my brain now about what's in scope and what isn't. So Schroders is, a large global entity. We've got lots of affiliates, JVs, subsidiaries. The first step really was identifying what was within our financial control boundary. So SBTi gives you two options, financial or operational. And we decided with financial to be aligned with our financial reporting. And then once we had identified those entities, it was a case of identifying which asset classes they invested in and which were in scope. So what is in scope mandatorily for now is listed equities, credit, REITs, ETFs. And I think going forward, the SBTi is looking to add to that, as well as provide the methodologies that will enable us to do that. For us, a big challenge at this first step was actually getting that data in a sensible way that aligned with how it needed to plug into the SBTi methodology. Getting the data cleansed and identically structured was challenging, as you can imagine, from a company that has grown quite organically with lots of different bolt-on acquisitions, different systems. So that was a challenge, but nonetheless, we got there. But once you have the data, I would say it's pretty straightforward from there. So steps 2 and 3, the SBTi is quite clear, right? You follow the PCAF, which is the Partnership for Carbon Accounting Financials, for how you calculate your baseline emission numbers. It is quite clear about how you calculate your temperature rating methodology, which is the approach, the third approach that Nate mentioned, that we decided to go for. And then once you've calculated your baseline emissions number and your baseline temperature methodology per security level, it then is just a matter of rolling it up to report a Schroders level. Obviously, one challenge there is then you need to make sure that you strip out double counting. So for instance, in the Schroders case, some of our multi-asset funds, for example, cross-invest in some of our other Schroders funds. So we just have to make sure that double counting is stripped out. And once you have the baseline, it's a straight line to 1.5. We know where the end goal is. You just draw a straight line, you put 2030 in the middle of that, and you have your interim targets. Now, clearly, that sounds a lot simpler than it was. Obviously, there was a significant amount of stakeholder engagement that we had to conduct internally, not least with all our fund managers and analysts, because they have to be on board with this journey because they will be the ones delivering on these targets. The senior management and the board were very easy to win over in that sense, but obviously they too had to sign off on these targets because we're committing to these. And we're making public statements. So it is quite important that everyone in Schroders is on board. And then lastly, I guess all that remains now is to accelerate our action. And I've put 2 on there, but I'm going to add 1 more. So primarily, we this year have really accelerated our climate engagement program. So for us now, it really is trying to get that emissions number and that temperature number now. And the best way we can do that as active asset managers is to use our engagement and voting power. The other way that we are going to do that is to develop more and more client solutions and products that are aimed at climate mitigation and adaptation. So whether that's looking at different asset classes, for example, pulling across public and private products, and really just creating the best products that can be created for clients to access the opportunities that the transition will present. The third one, when I say accelerating action, is really we want to obviously expand the asset classes that are in scope for SBTi. And I know SBTi hasn't yet made sovereign bonds, for example, mandatory, but that's something that we're looking at. Again, real estate is another one that we're looking at, and that will be interesting because it'll use a different methodology. It'll be the first one that Nate mentioned, which is the sectoral decarbonization approach. So I'm going to finish on the last slide with just 1 thought, really. So across the, so next slide, please. Next slide, please. Across the 4 boxes that we have here that outline Schroders' climate strategy. I'm not going to go into each of these boxes, but what I really wanted to emphasize is that the work that we've done to calculate our baseline, set our targets, get our targets validated by SBTi, all of that work has been extremely valuable, and it fits into every single one of these boxes. So my final thought that I'll leave you with is the same one that Nate ended with, which is please commit to SBTi, set some net zero targets, because we found this whole exercise extremely useful. And sure, there are challenges, but this is a new field for all of us. And our experience with SBTi has been they are open to comments and feedback, and they're continuously looking to update and improve their framework. Thank you.
To Stephanie and Nate. Stephanie, I've got a couple of quick questions coming in, and Nate also. What I suppose one of the ones that's always interesting with these types of projects, these types of processes, is looking back. What's the one thing you wish you'd known at the start of it? You mentioned there were a few challenges along the way. What were the, what would be your advice to a peer who is embarking on this journey, and where should they, where could they learn from what you've gone through?
I'm happy to start there. I think one of the things, if I could go back and redo again, was really just to make sure that all our data was ready from the start, instead of embarking on the process of developing the methodology and collecting the data at the same time, because I think that just made the process a whole lot longer. That would be one key one for me.
So you had to go and find all the data whilst you're also doing the methodology, which, as you said, if it was already all there, it'd be a more streamlined process.
Yes, also because the timeline is quite compressed, right? You have a finite amount of time once you've committed to submit your target. So really get your data sorted first.
Absolutely. Nate, we've got a couple of questions from the floor that are kind of related. One asking, how does the SBTi process relate to TCFD? Which relates to, I suppose, another question that a few people have raised of, we already have lots and lots of standards in this space. It's a sort of common complaint from some companies working in this space, is they just don't know which one to go for or the extent to which they overlap. I mean, what's your kind of response to those concerns?
Yeah, thank you for the questions. So I think, this is clearly a crowded space. SBTi comes to this space from our work with companies in the real economy, which we've been doing since 2015. And so I'd say there are three unique attributes to SBTi compared to our peers. One is that we do this independent assessment of targets that we've done with Schroders, where the financial institution meets public criteria, and it's a very transparent process for assessing those targets against the criteria. A second is that we have this connection with the real economy in terms of the 1,500 approved science-based targets of companies that have been set over the past 7 years, and these established methods for target setting among companies. And the third is that we really have a strong emissions accounting foundation here. This is all based on the greenhouse gas protocol, scope 1, 2, 3 accounting, and it doesn't include any avoided emissions or offsets or sort of individual counterfactual baselines. The idea is that emissions have to be reduced from a historical baseline, and that this is recorded in an annual emissions inventory. So that's something that keeps it simple and straightforward, that is unique among our peers. And that also links back with the TCFD, where clearly disclosure is growing. With last week's, for example, proposal from the SEC in the US to make climate disclosures mandatory. I think that this is sort of SBT 101 from our perspective, in terms of understanding your scope 1, 2, and 3 emissions, tracking the offsets that are being used separately, and really starting to measure so that you can then move to setting an ambitious target that is aligned with 1.5 degrees.
Absolutely. And Stephanie, was that your experience? Did you find that this process helped with your TCFD process, which you're obviously also working on?
Absolutely. I think that was a simple way to think of, or at least a simple way that I think about it. TCFD obviously covers, the 4 main pillars, right? Of which one of the key ones is the fourth one, which is metrics and targets. And that's absolutely where the bulk of our SBTi work comes in. But that's not to say that it hasn't been useful, for example, in communicating our emissions footprint and our temperature targets. We have naturally had to go to the board audit and risk committee. So we have naturally had to figure out how we're going to change our strategy. So it naturally fits into all the other 4 buckets of TCFD.
Stephanie, I've got another question for you from the floor. Bruno's asking, how did Schroders go about calculating its targets for scope 3? And what were the challenges in this task? I mean, it strikes, I suppose this must have been one of the biggest areas of a challenge for you, because you're one of the world's largest asset managers. You have stakes in huge numbers of companies. I mean, how do you actually practically go about getting that data off those companies? And are they conducive to that process? Are they providing you with the data that you need to understand your scope 3, or is it still a little bit of a guesstimate at times?
Yeah, really great question. I would probably try and answer that in two ways. So one is scope 3 of emissions, and the other is scope 3 temperature, and they're sort of two slightly different angles here. So PCAF is quite clear about when you include scope 3, when it's about a certain percentage, I think 40 of your scope 1 and 2 emissions. And it says for significant industries, for example, oil and gas, I think it starts coming in next year or the year after. In terms of the data gaps, I think you're absolutely right. Okay, so a lot of scope 1 and 2 data is reported, right? We get that data from third-party data providers, and PCAF has a very strict set of rules for how you go about filling in the blanks and how you go about estimating any missing scope 1, 2, or 3 data. As to the question of whether the data is useful or not, it's like with any estimated data and with any new field of estimated data. I'm sure, 20 years ago, people looked at, I don't know, price to book ratio and thought, not sure about that, but we have to start somewhere. And for us, at least starting with scope 1 and 2, which is the main focus for our midterm 2030 targets, while pursuing scope 3 to the best that we can, recognizing that there will be fluctuations, especially as, say, PCAF changes its guidance on what is the best way to estimate some of these, then we just have to go with the flow. But it really, this is really a new field for us.
Absolutely. Related to that, I suppose that the fact this is still a fledgling field in many ways, Nate, the kind of the biggest concern here, and we've heard it a lot, is are these targets credible? Companies.
Sorry, we can't hear you, James.
Sorry, you've lost me.
Yeah.
Am I back?
Yes.
There we go. I'm back. I was just saying the biggest concern here that we've heard a lot in this space is that companies can set these targets, but then are they credibly meeting them? I mean, and Stephanie did touch on how this has helped catalyse progress within Schroders, but that's not true in every organisation. I mean, how will SBTi be, I suppose, policing this and ensuring that there aren't people free riding by setting targets and then not delivering?
Indeed, great question. Thank you, James. So the SBT initiative has historically just focused on forward ambition, and one of our consistent criteria from the start in 2015 has been the requirement that the target setting entities publish an annual emissions inventory in order to track the entity against its target. This has been something that has been practiced across the approved targets, but it's not something that the SBT initiative has collected or analyzed itself. We sort of expected that other parts of the ecosystem would arise to fulfill this function, and it hasn't happened in the systematic way that we expected. And so one thing that the initiative has decided is to introduce a new monitoring, reporting, and verification function from SBTi, whereby the initiative will be doing performance tracking and assessment of approved SBTs. And this is something that we'll be introducing in the next several months and over the next year. And as with the rest of SBTi, this is a voluntary leadership platform. And so we'll be working with the target setting entities to gather the data and share the analysis. It's not a gotcha exercise. It's more trying to, again, just get more information out there and understand the emerging best practices and where there is some exceedance of targets. So, for example, we're presently working on our annual assessment report, progress report, and we found that it's been about a 40% reduction among those early Science-Based Targets Initiative companies that set targets between 2015 and 2020. So definitely exceeding their targets early on. And we do plan to do more systematic individual entity level tracking and publication of that information.
And presumably that means that, companies that aren't performing, that will become public. They'll have to reckon with that.
Indeed.
If I might just add to Nate's response, really, I think by getting a lot of financial institutions to commit to SBTi as well, part of your policing is effectively outsourced, because now asset managers like Schroders do have a vested interest, because we've set our own targets and we need our targets to come down. And so therefore, we really need to make sure that what's in our portfolios, they're also meeting the targets that they set.
Absolutely. And presumably this is also plays, Nate mentioned it's a voluntary platform, but in many ways, this is a forerunner for what we're seeing from regulators. I mean, I think the SEC's just announced its climate risk disclosure guidelines that it's consulting on. We heard this morning from the Business Minister, Lord Callahan, about the UK's rules that are coming into play. Stephanie, presumably, you know, this is from a corporate perspective a little bit about getting ahead of the curve because the regulators are coming.
Yeah, it is absolutely about getting ahead of the regulators. But it's also, as I sort of said at the start, it's common sense. If you're an active asset manager, you do need to be aware of what's in your portfolios because climate change and the climate transition is happening. Even if the regulators are slower, markets won't be. And we need to be on top of looking after our clients' money. Yeah,
absolutely. And just to unpack that a little bit, I was struck by your last slide about how you said this process had informed almost every part of what you do. Obviously, that's where this gets really exciting, isn't it? That having the target does evolve into investing in the right things and gradually moving away from higher risk areas. Can you just give us a little sense of how your colleagues have kind of welcomed this and how they are responding to having this target and, you know, maybe making decisions slightly differently than the way they would have done before?
Mm-hmm. Yeah, so I mentioned that one of the biggest things we're accelerating this year is our engagement program. And really what the SBTi exercise helped us identify which were our priority companies. So companies that we own a lot of that generally, you know, don't look that good on emissions or temperature ratings. And we sort of reverse engineered for us to get to 2030 and hit 2.2, which is what the temperature that we need to be at 2030 is. How many companies do we have to engage with, and do they have to successfully set net zero targets themselves, assuming, you know, X% success rate in a 3-year cycle? And so that has been an extremely powerful way of getting the message home to our fund managers and analysts that actually it is possible for you to carry on owning some of the stocks that you own, but you really need to start engaging with them today, and they need to have a clear path to net zero. So I think that sort of message lands well. Generally, fund managers don't like it when you say to them, you know, you can't invest in XYZ without any sort of explanation. So having this sort of data to show them that this path is possible, but we need to get your companies on a path to net zero.
That's really
that sort of message has landed well.
That's really interesting, and presumably that also tackles the risk of you just offloading and somebody else snapping up an asset and it doesn't actually change anything in terms of pollution levels. Nate, just want to bring you in on that point. I mean, is that what you see what in the wider market also, that the catalyzing effect of setting these targets does manifest itself in more robust engagement policies and the like?
Indeed. I mean, as Steph mentioned, you know, the asset managers, the way that they achieve their targets is by engaging with their clients to get them to act. And the SBT initiative's theory of change here is that financial institutions are most effective in supporting climate stabilization by engaging with their clients, with their investees and lenders, and borrowers, that is. So you know, we have been basically doing this for years through our Scope 3 requirement for companies in the real economy, where, you know, generally as a voluntary initiative, we often had consumer-facing brands and retailers coming to us initially who weren't really making anything. They were selling things that other people made. And of course, all of their emissions were in their supply chain. But what the SBT initiative did that was unique at the time was to A, require them to quantify their Scope 3 emissions, and B, as Steph said, to require them where their Scope 3 emissions were significant to actually address those with the Scope 3 target. And that catalyzing effect of having the buyers be asking these large Scope 1 emitters to reduce their emissions is much more effective than having NGOs or other stakeholders, or even governments in some cases, make that request, because buyers are the bottom line. And so that's really sort of why this is expanding so quickly and is having this catalytic effect. And so we're pleased to see that happening in the financial sector as well. I think there are unique challenges with financial institutions in terms of portfolio shifting. And so this is something that we're continuing to evolve, as Steph said, in terms of our new methods and new asset classes.
Indeed. It's going to be a fascinating, fascinating transition to watch. So much going on and growing fast. So huge thank you to Stephanie Chang and to Nate Aden for their insights. And thanks again to Schroders for supporting today's event. Thank you both.
Thanks very much.
Thank you.